A bank is a business which generates risky revenues from other people's money. The bankers make their money from other people's money is a well-worn complaint, one we hear time and time again. Whilst there's some merit in such complaints, or rather some merit in complaining about the underlying behaviour and hazards arising therefrom, the fixation on the idea of other people's money is a lazy cliche and a somewhat misleading one at that. But we hear it time and time again. It's often combined with references to gambling with other people's money. That kind of moralizing rhetoric often rides roughshod over legal and economic realities, which can be counterproductive or downright dangerous. By pandering to emotions, using concepts which seem intuitive without actually engaging in the legal and economic specificities, pressure groups can harness popular and political support for equally crude but emotionally intuitive solutions which too often distract from the real issues and the more effective solutions. Other people's money, it's an overused and trite cliche, and not a particularly helpful one at that. Speaking of trite cliches, I'm about to do that thing where I now reveal that the phrase I just quoted does not come from a recent news article or opinion piece, but yeah, you guessed it, from an ancient text, Demosthenes' speech on behalf of Philemon to be precise. Last year, I posted a couple of videos, drawing heavily in fact from Demosthenes, on classical Athenian lending practices, with a case study of a loan to finance a trading voyage from Athens to modern-day Ukraine. Well, this time we're going to look at the other half of the balance sheet, how bank loans were financed, specifically deposits, and whether deposits were actually other people's money. Welcome to Ancient Classics. How were loans in classical Athens financed? That kind of depends on the nature of the loan and its source. It seems that there were three main classes of loans or lenders. There were eronomoi, friendly loans, i.e. loans from friends, family, and one's broader social network. There were also loans from sanctuaries and public treasuries, and loans from bankers. Many have argued that the first two sources were predominant, and that bank loans made up only a small proportion of the market. Whether or not that's the case, I'm still going to focus on the third class, bank loans. So how did banks, or rather bankers, we're talking here about unincorporated businesses, so banks and bankers are legally indistinguishable. How did the bankers finance the loans that they made? In part, it seems they were financed from the bankers' own capital resources, but they were also financed by deposits taken by banks from other clients in at least some cases. But what actually were deposits? Before we get deeper into this, we need to consider what's generally understood as deposit taking today. Partly this gives us a reference point, a model or way of thinking about these issues, but we also need to be careful not to be drawn into the trap of just presuming that things back then were like they are today. We need to express our common understandings in order to resist being unconsciously beholden to them. Many of you know about deposit taking in the modern age, and you might want to skip to the next section. A deposit, as we generally conceive of the term today, is a kind of loan made by a depositor, such as you or me, to a bank. When you look at your bank statement and it says you've got 100 quid in your account, that means that the bank owes you 100 quid. It's not keeping your money in a safe somewhere. The bank, having borrowed cash, taken a deposit from you, is entitled to do what it wants with the cash so long as it repays your loan when due. So the bank lends some money to a company, one that needs money to buy a factory and kit it out. Of course, the company actually wants to borrow, say, 100 million quid, not 100 quid. That's okay because the bank has loads of other customers, all of whom have deposited smaller amounts with it. So it's like this: depositors lend collectively 100 million, and the bank lends 100 million to the company. But why is it so important that your deposit is characterized as a loan to the bank? I mean, it's possible to imagine other ways of doing this, right? You and a million other people have 100 quid to lend, and the company wants to borrow 100 million. I guess you and all those million other people could club together and lend to the company directly. Or rather, the company could put up an ad online or something saying, hey guys, does anybody want to club together and lend us 100 million? Cut out the bank, why not? Well, that would be a total pain. So the bank, acting as intermediary, does all the hard work of matching lenders and borrowers. Though even so, you could say, why doesn't the bank do just that? Act as a matchmaker and nothing else. The bank doesn't need to borrow from you guys and lend to the company for that to happen. And yeah, sure, that sometimes does happen. Like, for example, on a bond issuance, more or less. A bond, like a deposit, is just another name for a loan. Or on a peer-to-peer lending platform. And that's okay for some people some of the time. But there are at least two big problems with that. Because you might be okay with lending your money in principle to the company, but you probably want money back whenever you ask for it. back to your current account with the bank. You want to take out some cash, you go to an ATM and withdraw 20 quid, no problem. You're effectively saying to the bank, you owe me 100 quid, I'm demanding you pay 20 of that loan back now. It's fine. But remember, the company, the one that wants to borrow 100 million, it needs a long-term loan because it wants to borrow the money, buy and fit out the factory or whatever, and only gradually pay the loan back over time. It can't be doing with you and who knows who else saying, oh, please pay me some of my money now. But when you deposit cash in a current account, when you make a loan to the bank, you and the millions of other depositors are making an on-demand loan. You can ask the bank to repay you whenever you feel like it, and that's fine because it's the bank that owes you, not the company. So it's able to pay you because it's also made loans to thousands of other companies, any number of whom will be paying back the money that they owe to the bank right now. It really doesn't matter to you where the bank gets its money from to pay you when you demand to withdraw some cash from your account. This is basically what's called maturity transformation. In addition to maturity transformation, this system of deposit taking and lending serves another critical function, credit transformation. See, even if you were happy to make a long-term loan to the company, you might be concerned that it might go bust in the meantime. After all, it's just some random startup business that you've never even heard of. On the other hand, you're reasonably confident that if you deposit your money with a bank, well, you'll probably get repaid because the bank is less likely to go bust. So when I say that a deposit, as we understand it today, is a loan made by you as a depositor, as lender to the banker's borrower, well, it's not just a question of legal form. It's not just some random theoretical thing that only sad finance lawyers care about. It's absolutely fundamental to how the whole system works. And it's been functioning like that for hundreds of years, at least. So now we're ready to go back to ancient times. What were deposits in classical Athenian times? The thing is, no one knows, or rather no one can agree. Sometimes people disagree with themselves without even realizing it. The first thing to note is the terminology. Deposit, obviously, is an English word from Latin roots, I guess via Norman French, I don't know. It's not Greek. So what was the ancient Greek term to which deposit corresponds? Well, there wasn't a single term. The verb used to describe making a deposit generally tends to be tithemi, I place or variance thereupon. So making a deposit is just to place money with a bank or some such. From that, the noun describing deposits is usually cognate. A common term is parakatatheke, which comes from the same root. Alternatively, the word for lying, kemenos, can also be used to describe deposited money, as in peride ton paratuto kemenon, about monies lying with the bank. There are probably other words, but none of the ones I've mentioned really give us any clues as to the proper legal nature of the deposits, which is not too surprising. One can say the same about the etymology of deposit. So how have scholars interpreted the concept? In Millet's view, deposits, or parakatatheke, were entrusted to banks for safekeeping, much as one would entrust a valuable tangible good like some jewelry. Indeed, the term parakatatheke seems originally to have been used for such non-cash assets. If that were the case, then it would have been a breach of trust, or whatever the equivalent Athenian legal concept is, for a bank to use such entrusted cash for his own ends. Now, perhaps many deposits were taken on that basis and then misappropriated, but the fact that the practice of banks' loans being funded by deposits seems to have been accepted in principle, to me demonstrates that at least some deposits were taken on terms that were conducive to the financing of loans, and Millet acknowledges that, notwithstanding his general stance, though he believes such practices were rare. Cohen, whose main book on banking was published around the same time as Millet's, comes from the opposite camp. He is of the view that bank lending, and deposit-funded bank lending in particular, played a much more essential role in the classical Athenian economy. Cohen seems pretty sure that deposits constituted liabilities of banks, but some of his own comments seem internally inconsistent to me. But whatever, never mind what scholars have said or think about deposits, let's look at the evidence and figure it out for ourselves. The first thing to acknowledge is that there's no surviving treatise, theoretical or legal work on classical Athenian banking practice and deposit taking extant from the time, and likely there never was. So, as far as we're aware, there's no theoretical model, certainly no formalized legal system by which deposits arose and were characterized. Further, banking in classical Athens was more or less unregulated, so common practice was never defined or mandated. Any standardization, any patterns would have arisen from market practice and the functions such arrangements served. Identifying that market practice is difficult, in part owing to the paucity of evidence. Indeed, banking secrecy and client confidentiality was a thing, it seems, back then, and there is evidence that back then people deposited their money with banks expressly for the purpose, or at least with the effect, of hiding their wealth, or at least shielding it from public view, scrutiny, or their creditors, much like the uses that offshore and Swiss bank accounts were, and to some extent are still put to today, though in recent years the absolute secrecy and opacity of such accounts has been watered down. Much of the evidence that we do have comes from court speeches, which do not purport to discuss the nuances of legal theory, appealing more to the emotions, and like my opening rant about other people's money, can be misleading or downright dangerous for that very reason. So let's just look at the practices and behaviours and see what kind of deposit-taking model fits best. First, let's set out roughly the kind of basic kinds of models that could have been in play. First, we've got deposits in the modern sense, loans made by the depositor to the bank. The depositor has no direct right to or ownership over the cash held by the bank per se, or to the loans made by the bank. The other model that I'm going to suggest is some kind of agency structure. In that model, where a quote depositor quote deposits money with a bank, what they're actually saying is, here is some money, it's mine. Now you, bank, go out to someone on my behalf and lend it, and when they pay back, give me the repayment monies, but you deal with the details. That's actually how a lot of commercial loans are structured today, with a club of banks lending to a borrower via an agent bank, though each of those banks would have their own relationships with depositors for whom the agency structure and the end borrower is entirely irrelevant. It's also kind of similar to various trust arrangements and credit fund structures, but trusts are really a medieval English invention, so I'm not going to waste any time on that. Credit funds are interesting too, but my gut reaction is that they bear more similarity to the function of public treasuries and sanctuaries, an important class of lenders of themselves and one which we might explore another time. At the far extreme end, there's the model whereby deposits were kind of fiduciary safekeeping arrangements, whereby the bank took cash on deposit and had to look after it for the client and literally give them back the same coins, much as if, for example, one had left precious items in the care of a custodian. As I mentioned earlier, Millett thinks that this was the usual practice, but it is not conducive to on-lending, save in the case of misappropriation, though sure, misappropriation of funds happened then, just as it happens now. But like I say, there are too many references to banks making loans funded by deposits without any suggestion that the practice was dodgy or illegal. So I'm going to discount the fiduciary safekeeping model for deposit-funded lending. I'm also going to discount pure arranging or credit brokerage activities where banks put lending clients in touch with borrowing clients, but without the banks themselves intermediating in the flow of cash. I'm sure that would have happened, but it's at odds with the whole idea of deposits being taken by banks and contrary to the manifest examples of depositors suing banks for return of deposits, not the actual borrowers. So really, we're left with two models: deposits as loans to a bank, or banks acting as agent lenders. So let's look at the evidence and see which fits best. None of the evidence is conclusive, not least because no one even attempts to articulate the nature of the underlying legal relationships, but still one can draw strong inferences from the context. First point, credit transformation. Remember, that's how when you make a deposit with a bank, your risk is that the bank goes bust and can't pay you back. The fact that the bank might use that cash to lend to a borrower and the borrower might go bust is irrelevant. That kind of credit transformation is a core indicator of the modern deposit-taking model. So, is there any evidence of credit transformation going on? Some, yes. There's a brief passage in Isocrates 17. This is a speech written by the orator Isocrates for a client, the son of Sopaios, around 393 BCE. He was the claimant in a banking dispute against Pasion's bank. Pasion's bank, incidentally, is probably the best attested classical Athenian bank and features in several speeches of Demosthenes. The claimant begins his speech with the comment, "For contracts with banks are unwitnessed, and those who are wronged by bankers are forced to take action against them, men who have many supporters and handle lots of money because they are trusted owing to their skill." This phrase, trusted owing to their skill, or pistoi diaten teknen, this might be implied as meaning that bankers are trusted, not just in the moral sense, but in the sense that people are comfortable lending money with them because of their skill or profession, which in turn might imply that if you deposit money with a banker, there's less of a risk of them going bust because they are so savvy than if you loaned money to a random borrower, which would be the case in effect if the bank just acted as agent. But this is a very weak argument of itself. First, it might just mean that people are happy to lend through a banker because they can trust the banker to make sensible decisions as to whom to lend your money to. Or it might have nothing to do with insolvency risk at all and just be another way of saying that it's difficult to sue a banker because they generally have a reputation of being good with money, so a claimant faces an uphill struggle as far as credibility is concerned. More compelling to me is the negative evidence, the fact that in all the discussions I've seen, both ancient speeches and modern commentary, nothing seems to suggest that the banker refused to pay back a deposit because an underlying borrower did not pay back the loan obligation. To me, if a bank acted as an agent lender, then that would be one of the main arguments that would keep on coming up as to why banks weren't paying back depositors. But the argument just seems to not come up. Cohen states that deposits had to be repaid even if the bank, in seeking to generate revenues, had actually suffered losses, which would provide further solid evidence of this line of reasoning. But Cohen doesn't cite his sources, so I don't know whether there's any direct evidence for it. The same phenomenon, that bankers didn't seem to use the fact that their borrowers had not repaid loans as an excuse not to repay depositors, is also indicative of maturity transformation, another key element of modern deposit-taking and lending practices. Conversely, if the bank were acting as mere agent, you'd expect to see arguments along the line of, we're not paying you back until the end borrower's loan is due to be repaid, and I've seen nothing to suggest those arguments were made. Some of the nascent accounting and documentation practices and payment processes also indicate that deposits constituted loans to the liabilities of the banks. It seems like there was some kind of cashless debt settlement thing going on amongst the network of banks and their depositor clients. To quote Cohen, where payments were made not by actual transfer of coins, but by entry on the books of the bank favouring the recipient's account, the need for physical coins was obviously eliminated. This appears to have happened so routinely that the Athenians even had a term, diagraphe, for the cashless settlement of debts through bank entries. Cohen here cites Harpocration. I've not been able to track down the original source, so I'm going to lazily cite and rely on Cohen's footnote summary. Harpocration, under Diagrapsantos, in citing Dienarchus' speech against Lycurgus, notes that some people used the word Diagrapsantos, crossing out, or payment through the bank, hence paying through the bank. Since Dienarchus' speech from the 4th century has not survived, the context of Harpocration's gloss must be inferred. So, what I think is alluded to here is this. It seems that bankers kept accounts showing how much each client had deposited with them. A banker could repay a deposit by handing over the money to the client, at which point they would cross out the accounting entry relating to the debt. Fine, that's kind of obvious and it doesn't tell us much about the nature of the deposit. But what about if the bank's client wanted to pay a third party, and that third party owed money to the bank? Well, the bank could cross off in its accounts its obligation to repay or return the deposit, and likewise cross off or delete from its records the third party's obligation to pay a loan in the same amount owing to the bank. That way the bank's depositor can pay the third party and everyone's happy without the necessity for the transfer of actual cash. And you can expand upon this out to multiple levels across multiple networks, so long as all the banks in that network conform to the same basic practices. Well, what does that have to do about the question of whether a bank's deposits were debts owed by the bank to the depositor, or whether the bank merely acted as agent lender? It's pretty impossible to make those kind of cashless offsetting arrangements work when the accounted for entries and obligations are those of an entirely separate borrower. Perhaps not impossible, but incredibly complex, confusing, and one that I doubt would have been supportable in an economy of that size with basic record-keeping technologies. Also, it brings in the same maturity mismatching problems that we discussed earlier. This kind of system of cashless settlement also wouldn't work particularly well with fiduciary deposits, but I've discounted those anyway. Though I admit I'm taking a lot of Cohen on trust here, and remember, he represents just one side of a fiercely opposed view on these things generally. Another piece of evidence, which to me seems the most important, is all about a 4th century financial scandal. Our ancient source comes from Scholiast's commentaries on Demosthenes' speech 24. The Demosthenes speech in question has little of relevance to our present concerns, but refers to the fact that the inner treasury, the Hopisthodomos of Athene, had burned down. The Scholiasts explain the context. Apparently, the treasurers of Athene were secretly misusing or misappropriating the treasury's funds, defrauding the goddess and the state, so yeah, not ideal. The treasurers deposited some cash with some bankers, and that was contrary to their mandate. Presumably, the treasurers hoped that the bankers would pay interest on the deposits. The treasurers could then pocket the interest, and no one would have been any of the wiser because banking secrecy. But the banks went bust, so the deposits were not repaid, and the dodgy treasurers got found out, although they tried to hide the evidence by burning down the treasury. So yeah, talk about digging to try and get yourself out of a hole. This incident, or rather the bit where the dodgy treasurers illegally deposited the treasury's money with the bankers, is very illuminating. First, for the plan to have worked, the treasurers would needed to have been able to demand repayment of the deposits as and when needed so that no one would notice it had gone missing. So that implies that the deposit was on demand, another instance of maturity transformation. But more significant is the language used by the scholiasts. They say that the treasurers loaned the money to the banks, using the verb daneidzēn, the same word used for commercial lending. This word seems to puzzle Cohen, who remarks, "These funds are described not as deposits but as loans." But I don't see the slightest contradiction here in terminology. A deposit in the modern sense, and it seems to me in a classical Athenian sense, is a loan. True, there's the risk that the scholiast is misusing technical language, which frankly happens all the time, and like I say, we can never be sure that the banking practice was entirely consistent. But leaving all those major caveats aside, to me it's a slam dunk. Deposits in classical Athens were loans to banks, giving rise to repayment obligation of the banker to the depositor, just as things are now. All the other, albeit fragmented and indirect evidence points to that conclusion too. And one can reach the view without necessarily relying on technical terminology, which could just be misused or misquoted, but rather on the patterns and behaviours that we see arising therefrom. So I'm reasonably confident that, at least in those circumstances where bankers funded their loans from deposits, they did so in much the same way as we do today. They took deposits, borrowed money from depositors. The cash thus loaned to them was, at that point, the bank's, without prejudice to the bank's obligation to repay a deposit. Then the bank could lend the cash, its cash, to whatever borrower on whatever terms it wanted. Yeah, banks need to respect their debt obligations to their depositors and should be encouraged or required to structure their businesses in such a way as to ensure that they'll be in a position to repay depositors. And bad things happen when it doesn't work out like that. Bank insolvencies and financial crises, maybe we'll cover those in another time. Meantime, like and subscribe, and we'll be back soon.